Vipul Prasad, founder and CEO of Magadh Capital, joins in with his perspective on the markets. Vipul, good to have you on the show. What's your take on the markets currently?
Hi, thanks for having me on the show. Good afternoon. So, on the markets, I would say that lots of top-down drivers are taking center stage right now. So, the way to look at the market should be in over three timelines. So, first is obviously what happens between now and the elections. The second is probably we can look at the second half of 2019, and then obviously the way we invest, like more like a 2-3 year perspective. So till the elections, or rather till first half of 2019, I think the markets are going to be quite volatile, and I'll not be surprised if they end up where they started with. So basically between 30th June and 1st of January, probably there's not going to be too much of a difference in the market levels. And what are the key drivers here? The first one obviously is what is going to happen in the election. So every 15 days we'll come up with some new angles, some new ideas and some new expectations. So that will keep everyone on the edge. Secondly, even the global economic situation is showing some signs of softening. So that also may keep the markets range bound at best. And at the same time, we are also going to see earnings not going up at too high a pace. And with all these top-down drivers which are not looking too great, probably earnings multiples may come down further. So these are the things that may keep it under control in the next 6 months. Not much to expect from here, honestly. One more thing worth highlighting would be that probably it's going to be a replica of what we saw in 2018, as in like the defensives or some select large caps can continue to do well, while the small caps and mid caps and some of the higher beta sectors may continue to underperform. If we are able to look slightly longer, so in the second half of 2019, I'll be more constructive, because the first thing is that the political uncertainty will obviously be over, and at the same time we'll have a better visibility on Fed rate trajectory, because that has been a big driver of liquidity, obviously. So most probably we should be seeing a peaking out of Fed rate by late 2019. And one more thing would be that in the last, say, 12-18 months, overall, we have seen lots of stress in the entire banking system. At some point in time, corporate banks, then NBFC. So by late 2019, the banking system should be in a much healthier shape. So we'll be in a position to start financing the next round of private capex that is likely to begin, say, late 2019, early 2020. So all these things make us slightly positive on 2019. So probably late single-digit return percentage should be seen in the second half. And if we are able to take a step back, and if we are able to take a longer term view, let's say 2-3 year perspective, so the first thing that would come to our mind would be that whatever happened in 2018 should be taken more as a pause in the longer bull market that started in 2009. And
right, Vipul, now coming to the the sectoral part of it, I understand you are quite optimistic on market, and you are not seeing major concern as such, and then probably if elections are behind us, then probably the new cycle would start. Now, as I read your note, you are saying metals are in mid of cyclical stage, metals trading at attractive valuation. What makes you feel that metals are at attractive valuation? What parameters you are seeing? Can you just highlight it for our viewers? And any preferred names to invest in?
So in metals, if one looks at the price to book valuation metrics, in some of the stocks we are trading at multi-year lows. And if you take that in the context of metal price trends, as in like if we look at the prices in steel and aluminum, probably we'll realize that we are in early to mid level of the price cycle. So that means that we should not be expecting too much of a decline in steel or aluminum prices incrementally, and but the stocks, the kind of valuations, for example, Steel Authority is trading at 0.5 times price to book, so it has rarely traded at these levels, not on too many occasions, unless there's a call that there's going to be book value erosion. So that is highly unlikely. In fact, looks like that the market is building in significant price decline from here also. So that's why I'm saying it looks quite attractive. But having said that, it doesn't look like it's going to be a big rebound immediately. So one has to have some patience. And one more thing, it's not going to be the entire sector will be lifted. So in terms of pricing, there's no tailwind per se, or even from a regulatory perspective, I don't think the entire sector will benefit from some big regulatory dole out. So in that sense, sale looks good. Even Nalco looks very interesting because they are getting some volume growth. Their cost is very well under control. Their balance sheet is very strong. So I think these two stocks look good.
Okay, Vipul is still with us. Vipul, we're counting down to market close. Very quickly highlight to our viewers what are some of the top themes that you are advocating to clients or are bullish on.
So see, the first one is rising disposable incomes. So consumer staples look very interesting in that count. So, and apart from rising disposable incomes, the rural economy getting strengthened, that also is a strong theme on this one. So obviously volume growth is picking up and will continue to be so. So in that sense, some of the FMCG stocks look quite promising, even though they are slightly on the higher side on the valuation multiples, but still effectively one is paying for the quality and one is paying for the clarity on the 3-4 year earnings growth. So if not more, at least in sync with their earnings growth. So even if there is no further re-rating from here, at least they are not going to be derated. So if they are able to say deliver earnings growth of 18-20% per annum or even 15-18% per annum, then 4 years from now you'll see them doubling from here. So that is a good theme in my view. Another one would be slightly beaten down sectors like metals or particularly autos. 2018 Nifty Auto Index was down by almost 23%. In my view, it was highly cyclical in nature, the dip in volumes, and it's a matter of maybe a couple of quarters before some of the leaders start seeing sizable rebound in their volumes, and that will be probably driven more by the longer term trends like improving road networks, rising aspirations, very low penetration of automobiles in India, or maybe even shrinking size of families. So all these are pointing towards a sustained period of high volume growth for some of these companies who have the commitment that is required to stay and win in this market, and who have created a kind of distribution network that is required for that. So especially some leaders who are planning to launch many more models than they have done in the last 12-18 months, probably they can see sizable volume growth. So, and also in this space, if you are talking about autos, the decline that is so, even as the earnings were kind of reasonably moving.
Okay, we have a feed problem over there, but Vipul was clearly highlighting FMCG space, though they are expensive, it's a good buy. He's seeing clarity, 15 to 18% growth. Metal, he already mentioned SAIL and Nalco are his preferred pick because of the valuation comfort. He also spoke about, some of the auto majors like Maruti and Eicher, and he's expecting he's expecting good launches of new product that would probably reignite the sale momentum which has been on the downward spiral when it comes to Maruti and Eicher. Vipul, sorry for that, we have you on a very bad feed. That's all we can, extract from Vipul.